All right, Alan, we have Linda here now. So our speakers are fully constituted, and I would like to thank everyone for your patience. I'd like to hand it over to Alan now to run us through this session, and a warm welcome to everyone.
Thank you, Ruth. Good evening, everyone. Welcome to our webinar on Beyond Bonds and Equities, why East African institutional investors are looking at alternatives now. We are very delighted to have you join us today to speak about this very important topic that is taking over boardrooms across the pension space, across endowments, foundations, and we are seeing a lot of interest, both from the fund managers and investors as well. So we are here to hear from two different dimensions. One is an institution that seeks to raise funds, and another is an organization that supports investors to deploy capital across different investments. And so we'll be hearing from our speakers today, who are coming from Sanlam Alliance Investments. And we have the Uganda General Manager with us today, Mr. Mobale Mogalia, is here to share his perspectives on what he sees across East Africa. And on the other side, we have Ms. Linda Soare from the Trade and Development Bank, who will also give us her perspectives on what she has experienced trying to raise capital across East Africa. Permit me to invite our panelists to greet us and to speak to us in a minute. But before they do that, I'll also introduce myself. My name's Alan Luetabe. I'm a Director Investment at the Deposit Protection Fund, and I will be moderating the session today in this particular webinar hosted by the CFA Society East Africa. Allow me to invite Ms. Linda to share one or two greetings to the audience, and then Mr. Mobale as well, before we jump into the questions of the day, such that we can recover some time, but also hear from their insights as well. Ms. Linda, kindly introduce yourself. Thank you very much.
Thank you very much, Mr. Moderator. Thank you, Alan. Good evening, morning, afternoon to everyone, depending on where you're watching us from. Is introduced by Alan. My name is Linda Tsarwe. I work at the Trade and Development Bank under the Asset Management Division, where we manage a number of trade funds. I think we have interacted with some in that are joining the webinar, and maybe for others, they're hearing it for the first time. So I hope to share perspective on that and sort of give practical examples, especially when we're looking at alternative investments. So thank you very much to also the CFA Society for having me, and apologies for the slight delay as well. Thank you.
You're very welcome. Thank you for coming and joining us as well. But Linda, just maybe a little bit from you, just use a minute to speak about what Trade and Development Bank is doing, particularly in this particular area of alternative investments. Can you use a minute or two just to speak to that?
Yes, definitely, sure. So we've been very active on this side of asset classes, mainly starting with the trade funds, where TDB in 2019 launched its first trade finance fund, a regulated fund that is domiciled out of Mauritius. And this has been a fund that we have been offering as an investment option to a number of investors across Africa. And we're actually happy that we've also managed to attract money outside Africa because of the lucrativeness of the investment, and also it being an alternative investment that offers decorrelated returns to traditional portfolios. We then went on to launch another fund last year, a medium-term fund, also looking at trade, but just longer duration. And this is a second addition to what we're doing in terms of alternative investments. And these funds sit under the asset management of TDB. But also just to add that as TDB, the bank, we are also working on a number of other investment opportunities. I think the most topical one is with the infrastructure fund, which I think has had a lot of interest, especially from institutional investors, because it's like us pulling money together to help build the infrastructure of Kenya, and everybody can see where that money needs to go to. It's securitized, etc. So it is also offered, it's also another investment product that is offering a good opportunity for investors to actually look at from an alternative investment space. Thank you. I think that was over 2 minutes, but thank you.
No, but that was fantastic. Bali, do you want to go next? An introduction, and then you can speak about Sanlam Alliance as well.
Yes, good afternoon, everyone. My name is Mubale. I'm the general manager at Sanlam Alliance in Uganda. And we are a traditional fund manager. We are the people who get the bashing from the alternatives community that we're not doing enough. So I'm here to defend that side of the business. We manage money for pensions and unit trusts. And we also have investors from outside the region. So we are happy with the growth of the industry and the business. And definitely alternatives is taking on a lot more prominence as we progress. Yeah.
Thank you, Linda and Mubale, for those intros. So permit me to dive deep into our questions for the day. We are looking at going beyond bonds and equities. Why are East African institutional investors looking at alternatives now? And I'll start with you, Mr. Mubale. What are those factors that are driving this shift in mindset? Why are we seeing more pension trustees, endowments, foundations, sovereign public sector asset managers exploring alternatives today compared to yesterday?
So as professionals, you are aware of the environment with which we operate. And for this particular topic, there is the element of crowding out by the sovereigns, the amount of appetite they have in the domestic markets for borrowing is quite big, and they've been paying very healthy returns. So we've had a scenario where the concentration has been there, it is still there in terms of sovereigns. But the shift towards alternatives, whereas discussions have been ongoing for a number of years, the allocation or the amount that is going there, it is ticking up, but I feel, or we expect it to tick up even much faster for the reasons that concentration is a problem. And there was a time where private equity was, you can call it, was like a fashionable thing to do. But now we are moving more towards we actually have to do it. So we are trying to move away from the concentration. It's apparent. Everybody talks about it. And even when you move to, let's say, the equities that are listed, which are few in number, you would find that there are some, for example, the commercial banks have a massive exposure to government securities. So if you are to look through, if you've bought shares of a bank, indirectly you have almost a 40% exposure to government securities. So from a concentration perspective, that is something that we are trying to work around. The second element is that when you look at the yields, maybe not so much in Uganda, but in, say, Tanzania or in Kenya, we expect the yields to continue compressing. So yield compression will always drive or would make other options a bit more attractive. So if you have a government security at 18, 20%, and that moves down to maybe 14, then you'd find that there are alternatives that you would not you wouldn't have looked at, but now you have to actually look at them in order to perform for the customers. The third element that we've seen that has driven the shift. So across the region, if I look at all the fund managers, say 10 years ago, and which manager was, for example, managing hard currency assets, be it an exposure into offshore or private equity or any other asset that is in hard currency, that quantity was very small and the percentage was small, but we've seen a significant growth in hard currency assets. So for example, like in Kenya, when the currency was quite volatile, we saw an increase in uptake for dollar products. So you'd find that alternatives, most of them are they are valued in dollars, or the return is sort of given in dollars, and that is something that is then driving uptake into alternatives. Now, the last two are related. The last 2 points I would want to make are related, that the regulatory space is fairly okay. There are a few constraints, like in Uganda, where a pension can't invest outside of East Africa, but there are workarounds around that. So we have limits. There are limits that we can use. That is not a problem. There are other places in the world where that can be a problem, but that's not within East Africa. And as a region, I would say we are quite excited about the entire growth of the region in terms of macros, in terms of GDP, in terms of the regulations, the quality of the general partners within the region, and also the amount of money that we as fund managers have available, institutional managers have available to deploy. It's been growing 20-30% per annum, and that's a good growth, and that's why you've seen quite an increase in fund managers, not just in Uganda, but in Kenya and Tanzania. Yeah, so that's the call it the basis for which then allocation to alternatives is gaining traction.
Mr. Malik, I just have two follow-up questions on your insights. One, we are seeing a peculiar challenge that the yields on alternatives are not dissimilar from yields on the traditional investments, particularly fixed income. How is that driving the allocation? If a fixed income asset, an infrastructure bond, can deliver 18%, and an alternative is offering 20% or 18%, how does that influence decision making for investors seeking to make a decision on where to allocate their capital?
So from my experience, at least in terms of let's take the private equity funds that we've interacted with, we tend to look at the return from a dollar perspective. So you'd find that dollar returns are slightly lower than what you'd get on hard currency. Now, when we look at the performance for different designs of funds, a good fund is going to return net of about 12% in dollars. So which is a good margin of, let's say, other lower risk dollar assets, which could go for, if you're looking at Euro bonds, maybe you're talking 7-8% right now. And if you're looking at deposits, those are about 4.5%. So there's still a good margin when you look at it from a dollar perspective, and also from you can say hedging perspective or diversification, then hard currency offers a bit more to the portfolios than local currency exposure.
Thank you very much. Linda, let me just bring you in here a little bit. I know you've been, you highlighted that you've been raising funds both within Africa and beyond. What have you seen are the indicators from investors on what is driving their decision making to allocate to your funds, to allocate to alternatives? What are those telltale signs, characteristics that you have seen of investors that are willing to make the shift to alternatives?
Okay, there are a number of reasons or a number of considerations. It also depends on the investor type and also the geography of where they are. I think the greatest reason we've seen amongst our local African investors has been diversification. So we are bringing in a product that is very decorrelated to traditional assets. And as portfolios are looking for alternative investments that actually bring that diversification, our funds have been well suited to actually meet that need. So for most of our institutional investors, we've seen the need for diversification in terms of asset class. But also there's also a need for diversification even in terms of currency. Our funds are dollar funds. And for those that have access to dollars or that can convert to dollars or that actually receive dollars, they're looking for investments where they can be able to invest in dollars. We've seen a lot of dollar funds coming out of Kenya, coming out of Uganda, and even in Tanzania, it's starting. And these dollar funds usually come with lesser restrictions as compared to, say, pension funds. So it gives them leeway to explore offshore investments. And being a dollar fund, you're also wanting to look at, I mean, offshore tends to be sort of your market because you're looking for dollar assets anyway. So we've seen this need as well to just diversify assets even in collective investment schemes, and also just looking for the right assets for the dollar unit trusts. We have seen a lot of that demand as well. And then secondly, I think return risk perspectives, because if you look at trade finance funds, they're very low risk, but our return has been quite robust given that risk. So from like a Sharpe ratio measure perspective, we are giving very good risk-adjusted returns. And as a result, they've worked even for like the dollar funds I've mentioned, where in terms of what they have been giving as returns to the market, the assets then were suitable for that kind of return profile. We've also seen that for pension funds, they're also looking for that diversification as well as risk. So it's a combination now for pension funds to say, okay, this is diversified, but also there's a return element to it. So it's sort of helping them to satisfy two requirements in one. And also on the risk perspective, you'd find for the investors that we've received out of Africa, compared to the markets, to their markets where they're domiciled, the return that we're offering them, or the Africa return that we're offering them, is actually much higher than what they'd get in their own jurisdictions. But then now, for those that are outside Africa, there's also an element of being afraid of Africa risk. And where we come in is that we're coming in as an Africa fund manager, where we have business in Africa, we do business in Africa, and we're able we've got our networks, we understand the market better, and we're offering them a diversified portfolio where we have exposures to a lot of African countries. So for them, it's like a one-stop shop where they can be able to invest in all these countries through the fund, because we already have exposure to all these countries. So for them, it's also an entry into Africa. So adding an alternative investment, that is just not within their geography, but also getting into Africa and getting into Africa through a somewhat de-risked vehicle for them. For us, we've seen that also as a driver. And then the other thing as well, and I think that it has been a weakness in alternative investments, is you get a lot of questions around governance, you get a lot of questions around security. I guess maybe history hasn't done good for us in terms of maybe other funds or other investments that haven't gone so well in the alternative investment space, mainly due to governance factors. So even if you give them an attractive return, even if they can be able to show the fundamental benefits of investing in the fund, you still need to show that you're a solid fund from a governance perspective. Are you regulated? Do you have a board? Do you have an investment committee? Do you have controls that are managing risks? And in addition, are you even rated as a fund? So all these things brought together also, they've been asked because it's very important for their risk management. And those are some of the things that I've seen that have driven people into invest alternative investments. On overall, they want, but you also have to then tick the boxes. It's still an investment. Do you tick on return? Do you tick on risk? And then, of course, the diversification benefits is most cases apparent, but also do you tick on just general governance as well?
Okay. Thanks for that. Just on this point, and this goes, we are seeing the framework of the ESC. Does that create more opportunities for alternative investing? Are we seeing more flows towards the new countries that are joining the ESC, or are we seeing a concentration in Kenya, which is the more mature ESC country? What is the opportunity like from a political standpoint with the enlargement of the ESC? That's really my question to both of you. What are you seeing from where you're standing?
Yeah, I guess I could start on this one. So I think obviously expansion of EAC is great for us because we get to see more markets and we get to have that sort of experience and network with a larger market. Of course, for us as a fund, we have been an Africa fund focusing on African markets, regardless of whether they're in East Africa or not. But just that as well is also very good for us. I think even though we are in community, you find that the economies are not the same size. And that in itself then indicates in terms of value, where you'd get most value as compared to another market, because you're looking at economies that are different in terms of size. But there are a lot of similarities around these economies as well, to the extent that even if you get a lot of your money from, say, the Kenyan market, which is the largest, and in our case also, we've really received a lot of money from Kenya, naturally because of size, it is a very positive ripple effect to, it could be their subsidiaries that are in Uganda or in Tanzania, or even just any other asset managers that are in Tanzania, Uganda, Ethiopia, etc., in the sense that you now have these as like your case studies. They even consult and they get to understand that this alternative investment, we've invested in it and it has been successful. We are happy with it. And that positive ripple effect then tends to then help us also in terms of fundraising, but not just fundraising, but even just development of markets. So the moment you are developing alternative investments, you're going to the markets with a product that they can now consider. So you're expanding those markets. So even in markets where maybe the universe of investable alternative investment assets is not much, the moment you get there, you're already expanding that market. And if you have a track record, if you have case studies, maybe you've started off in Kenya and you're going to, say, Tanzania, and you're discussing with them, you tend to see a very positive response because they also sort of share notes, across the region. Asset managers tends to share notes. So I think the expansion is really good because we get a lot of people in the pool. We share notes. We provide alternative investment products that then expands the universe of alternative investments that are investable for investors across East Africa.
Thank you very much. Mr. Mubale, any thoughts on that political question?
So I from my experience, I haven't yet seen, and it could be just me as a person, I haven't yet seen, say, like a fund manager in Congo, deploying money, simply because I haven't been there and I don't speak French. So it could be a shortcoming. But we had our Pan-Africa Fund Managers Association earlier this year in January. And we had fund managers from across Africa with us. And I get a sense that there's activity that is ramping up in Ethiopia. I know Ethiopia is not yet part of the ESC, but when I see, if you go to inter-country regulatory meetings, you will find East Africa regulators with the Ethiopia regulators, trying to share notes, trying to encourage people to go and register businesses there. Next month, which is starting tomorrow, I've been contacted by a couple of people from Ethiopia coming to see how fund management is being done within the region. So I would say that I get a sense that Ethiopia is they are pushing on the right things, at least in the short to medium term, and then the other countries will naturally benefit from that. So that is the only addition I can give to Linda's response.
All right. Just to delve back a little bit, we need to demystify alternatives. What does alternative mean from the Sanlam and Lear's perspective? How do you classify that? How do you craft that as a product for your clients?
Let's just say if it is not on the securities exchange and it is illiquid, most likely it's going to go into the alternative thought process in nature, because it requires a slightly different perspective of looking at it. The normal traditional assets, the way you look at them is not the same way you look at alternatives, simply because of how do you price it, and what's the liquidity on that asset. So anything that is fairly liquid and has pricing, I don't want to call them challenges, but you have to do a bit more extra work than get a price on an exchange or call a bank to give you a price. Then by definition, it becomes an alternative.
All right. From where you are seated, what are those alternative assets that are coming into favor, that perhaps resonate more with institutional investors? What have you seen in the boardrooms seems to be the gravitation in terms of alternative assets?
Yes, so the thinking in terms of design is not different. Just like if you're going to look out for which companies to buy on an exchange, you sort of set out some type of a screen or a sieve. I want something that is liquid or that is in this sector, etc. So with alternatives, I would say that infrastructure kind of assets are quite good. They are very easy to explain to clients. So if you have a toll road, it's very easy to get your clients into a bus and take them to the toll road and show them how the money is being collected. And the business is not complicated. It is a road, and people are paying to use it. And whatever they pay you, you keep a portion of that. So infrastructure is something that is getting traction. When you look at also other managers across Africa, especially the big funds, you would find that when it comes to alternatives or in terms of funds, the allocation they are willing to put in an infrastructure fund, the quantity can be like 10 times or even 20 times what they're willing to put in a private equity fund. So in terms of allocation, I've noticed that there's legroom on infrastructure in general. And then the other two areas that are really are growing is private credit or credit funds, or and then the trade finance funds, like Linda has mentioned. And the appeal there is that they are fairly short term and they self-liquidate. So you don't have challenges around exit. And as you are aware, the longer the exit, the returns do come significantly. So those are the three areas that we feel are gaining traction.
Thank you very much, Mr. Mubale, for that. Linda, perhaps we can also now hear from you. From the exercise of raising funds, what have you seen? What is the gravitation in terms of the products you have offered, the sectors you have funded? What are investors gravitating to in terms of preference? Are there some insights we can pick out from your fundraising journey?
Yes, yes, indeed. So, firstly, I agree with Mbale a lot in terms of infrastructure, because one of what makes investors comfortable is to actually see what they're investing in. So, like you're saying, if you take them to a road, then they can actually see the road, they see the tolling happening. It gives some certain level of comfort. Of course, it's not every investment where you can physically take people to where the investment is. So it's a question of you having to then discuss with investors and convince them what exactly you're doing once they've given you their money. One of the things, or I know most people when they look at alternative investments, in a lot of conversations, it has always been seen as private equity. Every time you mention alternative investment, everyone is thinking private equity. And I mean, the whole concept of the black box of private equity doesn't sit well with a lot of people. So already when you're bringing alternative investments, they're thinking maybe yours is a black box as well. So that's why infrastructure fares well, because the road is there. So I think we have had to do a lot of education as well, just to show people that there's a whole lot of other investments that are out there. So first of all, for us, we've been doing a lot of training, and then also a lot of marketing of the trade finance funds, which fall under private credit. So largely we're looking at private credit as an asset class, which Mobale touched on briefly as well. It's gaining momentum, especially in the African market. And we've been able to give that comfort, because if you're bringing in private equity, there's a lot of liquidity that is there. So you give people a lot of options to exit, and they can exit flexibly. And that has made the product quite popular, because there's that arrangement in which people can be able to exit at a point where they're flexible to do so, and in shorter notice periods. You don't have to necessarily wait for a private equity exit, for example. So we have seen a lot of interest around private credit. And of course, us bringing trade finance funds as private credit products has also gained a lot of momentum, because now we're teaching people what exactly it is, what is it that we're funding, how do we get our money back, what are the safeguards, and all that put together now has made a lot of people quite comfortable and has increased their demand around that. Back on infra as well, you'd find with infrastructure, fund managers have also been doing a lot of things, including TDB, to structure infrastructure in such a way that you can even be able to pool funds and then use those funds to invest in infrastructure, and then even create some form of liquidity events should you have others that need to exit. So I think there's a lot of structuring that you can do with infrastructure, which is what we are also doing from the bank side. And that then becomes a great product, because like we're saying, you like infrastructure, you can see the road, you can see whatever it is that is being constructed, but you're also getting into a structure which maybe gives you some form of liquidity, very good returns, and also being managed by someone that you trust. Sectors, I think when it comes to sectors, Africans have always been very particular about the sectors that develop their own economies. So the moment you speak to someone in a particular country, they'll tell you, oh, in this country, we're very big on agriculture. Are you doing anything on agriculture? We're big on mining. Are you doing anything on mining? We know oil and gas is not the favorite at the moment, but this is what we do in this country. Are you supporting that? So you'd find at the end of the day, yes, people are very commercial, they want return, but there's an element of development in all of us where we also want the money that we're giving funds, the money that we're giving investments to also be plowed back into Africa, into sectors where there's a lot of need. So sectors that are developmental have been a very big darling to a lot of investors, especially institutional investors. So yeah, that is sort of what we've been seeing. And then, of course, when you go across Africa now, you tend to get a lot, maybe somewhat different stories sometimes. Like if you tell them that our fund does support oil and gas, they might actually say, oh, we can't invest in that because we don't do oil and gas. So you tend to get that maybe outside Africa because they have other sectors that they don't support or they don't invest in. But in Africa, in terms of sectors, very much open to anything that comes to developing the continent. And oil and gas is not excluded in that for our fund at the present moment. Yeah.
Good stuff. Shifting to the global space a bit, we are almost in the phase of global fragmentation that is happening. Is this an opportunity for alternatives in Africa? Now that the US, China, there is all these fissures in the global architecture, does that make African assets more attractive, African investing more attractive from a home perspective, but also for foreign investors? Is there any chatter that you are picking up in your research about this? Perhaps we could speak to that as well.
Okay, yes, sure. So a lot of mixed reactions. I think, like you're saying, there's a lot of global fragmentation. And there's been a lot of talk around each country putting it in their own interest first, regions looking internally and protecting their own interests. So when we have had a period of globalization, I think it's still there, but there seems to be some few steps being taken backwards where people are now sort of looking at their own interest and trying to guard their own interest. So what this has done is it has, in certain ways, it has disadvantaged us because sometimes we, as a continent, we used to depend on other regions outside the continent, be it to provide aid to our healthcare, for example. So this has also sort of gravitated into investments. As a continent, we were already being seen as very high risk, and therefore we were not getting as much inflows as maybe other emerging markets, for example. And if we were getting any money, it was coming at a very high premium. So now already with all this that is happening, it means we are in an even tighter spot. So the trends that we are then seeing and even discussing at different conferences is to talk about how Africa now can start looking internally as well, like what everybody else is doing, and start investing in the continent. So I know when most people, when they think offshore, they are looking at funds maybe that are managed in the US. They are looking at equities in the US. Nothing wrong with that. It's very important to also balance your portfolio and have exposure because there's been great returns that has come out of these markets. But also as a continent or even as regions, as East Africa, we also need to try to start and see what we can do in terms of investing in-house. I mean, you don't blame people for investing offshore, like in global companies or global asset managers. What is important is for the continent to also develop viable alternative investment instruments, which are available, which when a person or an investor does due diligence on, they can satisfy themselves that this is a solid investment, robust. I can actually invest my hard currency or my local currency, whatever the case may be, into this particular investment and get the sort of return that I am expecting, get the sort of benefits, get the sort of level of risk that I would be looking for if I had gone elsewhere. So it's a mindset shift, I would say. And for people who are used to probably looking at certain types of assets or certain types of funds, it will take time to then educate to say, now we need to start looking inward and also see how we can bring savings together, African savings together to fund African projects. And it is necessary because everybody else, that's what they are sort of now doing, given where the world is. They're looking inward and there's lesser and lesser funds coming to Africa. And then further on, you also asked about whether the global market is also looking at us and seeing us as attractive. I think not yet. To be quite honest with you, not yet. Of course, yes, we are sort of in a better position relatively, but not yet, because first of all, we need to debunk why we were being given such a high risk premium, even when it is not justified. I mean, there is a level of risk premium that you could say, okay, fine, yes, this is Africa, these are the risks they are talking about, but it's quite significant, and there's a reason why that is. And when you speak to people, they have experiences sometimes in terms of their investments that they've done in Africa. So maybe we still have a work that we need to do as a continent to actually show that we do have viable investments that can be able to return without having to expose outside investors to risks that are necessary. But also, it will take time for them to actually then start looking at us. So capital is, like I said, is actually becoming tighter in certain things because of this whole looking inward. But African assets are still attractive. We just have to do a whole lot of work. And I guess it's an opportunity, given what is happening, to actually start marketing our investment products to them. Yeah.
Thank you very much. Mubale, any rejoinders on that?
I think, yeah, I like what Linda said in terms of risk premium. You'll find that a sovereign like Uganda borrows at a higher rate than a student who's getting a first-time mortgage just because they have a job in be it China or somewhere else. So, but that's the reality. So you know, it's a struggle. Now, in terms of the whole global shift, my take is a bit different in terms of just trying to assess where we are now and what is likely to happen, say tomorrow or in a short period. So in the political space, it's very nice to talk about the shift. But when you come onto the ground, you ask yourself, okay, if I'm going to list out all the sectors that would probably exist in an economy, and in Uganda or any other country, is there a shift in those sectors that is looking inwards? Then the conversation, is not very clear. So, for example, let's look quickly through the sectors. If it is utilities are geographically bound. So there's probably not going to be a change in how we are thinking about our utilities. If it is industrial, for example, Uganda is trying to do some type of industrialization. We'll see how that goes. If it is healthcare and other materials, technology, are we investing significantly in terms of R&D to actually take those sectors? So, for example, we have the whole artificial intelligence, and companies are raising massive amounts of money to invest in that. Is there any African country that you would say is a leader in that space? I don't see that happening. Real estate is all about the location, so that's probably not going to change. In terms of financial services, perhaps we will see a bit more money moving around. So 20 years ago, maybe within our own countries, it would be unheard of to find a Ugandan investing in Zambia. But now, even going forward, maybe that could ease if the capital accounts do allow for the movement of money. So the shift around geopolitics and etc. It can look appealing in terms of thought, but when you break it down to who is doing what, then you find that some areas might move maybe faster than others. Yeah.
All right, thank you very much for those thoughts. I have two more questions before we open up to our audience to do a few Q&As. I have two quick questions. One is on exits. In Europe and America, we have seen the growth of private equity secondaries as mechanisms of creating liquidity, making funds tradable on stock exchanges. Is this something that perhaps is due for consideration in East Africa? Perhaps bringing an increasing role for the Nairobi Stock Exchange or Dar es Salaam, Rwanda Stock Exchange and Uganda into play and having a bigger role in alternative investments. Is this something that perhaps where you are seated makes sense in your structures? And I'll start with Mubali, then Linda. Does it make sense to have an element of tradability as we are developing fund structures?
Yes, I would. Okay, the thought that I feel that makes sense is, for example, a structure of a fund of funds, which would probably, improves on how an investor can participate into, a structure of a fund of funds. In terms of stock exchanges, we have experience of companies on the stock exchange where not even one single share is traded. So just because the shares are on the exchange, that doesn't mean that they are tradable. Again, it goes down to the fundamentals of the business. But in a fund of fund structure, then you have maybe improved liquidity events, which improve the cash flows, and it improves around things like vintaging and sectors. So you find that the blend then sort of helps with the conversation with investors around interesting new investors into the fund, while others want to exit. So that instead of having a fund one, fund two, then you can have a fund of funds, but because it has multiple vintages over time, and is creating liquidity for investors, then you can have some join and some leave without feeling the drag on exit.
Linda, any thoughts from the TDB side? How best do we improve liquidity at exits? Is there a mechanism we can bring on board tradability and perhaps leverage securities exchanges?
Theoretically, listing is always that avenue, right? To create liquidity, create an avenue for exit. But then it doesn't always mean that if you've listed, then
we seem to have lost Linda.
I thought it was on my side.
Oh,
Yeah.
so Mupale, perhaps as we wait for Linda to jump back, ESG, uh, it has been all the rage in Europe and America for the last 20 years. And Africa is just picking up the story, particularly in Uganda here. We're just picking up on the story of ESG. How should we factor that in when we are thinking about alternative investing, at least from this part of the world?
So I would say that there's been there's been engagement on ESGs, and I believe particularly managers who do funds, ESGs is not a thing that they actually compromise on because of the benefits in terms of managing risk. And we all appreciate the benefits of governance and reputation and things like that. So ESG is something that has been there. And as you're aware, the disclosures are, as per IFRS, they are coming. As fund managers, we've already received a draft of the regulations or guidelines from the capital markets. So I would say that by 2030, it's going to be mandatory for everybody to disclose on ESG. So it's going to be a good thing. It comes at a bit of a cost as businesses, the smaller the business, it becomes a bit of a cost. And the GPs will struggle with the investee companies if the investee companies are not seeing this thing called ESG because they're interested in making money, and yet as an investor you want to show the relevance of that. I get a sense that it is something that is going to be around. It's with time everybody will know what to do. There are going to be templates. There are going to be some work done here and there to push that work out. I see a bit of opportunities for the audit firms to make some money as the IFRS kicks in. That is S1 and S2. So on our side as Sanlam, it's already part of our investment process. And as a firm, we also ensure that we do a couple of things for our communities and trying to manage our printing, our energy, so that we don't only go to investee companies to demand for, responsible, sustainable investment, but we also have actual measurable outcomes. As a group, we are signatories to the Sustainable Responsible Investment Principles, the UN principles. So for us, we don't have any, we are far ahead, but I see it as something that is part of the fabric. Just like there was a time when, I'm sure 100 years ago, audited financials were not a thing. Somewhere along the way, we got standards and etc. And businesses used to operate even without audited accounts. But now, if you talk to any alternatives or fund manager, then audit is something that is sort of like a requirement. Yeah. So ESG is something that we see. Linda talked about the whole oil and gas. Are you out? It looks like the conversation has softened a bit over the last 2 years around oil and gas. It has softened, and with the constraints in the Middle East, you can see how oil and gas is actually an important piece in the energy mix for countries. Yeah.
All right, thank you very much. We have one question so far from Philip Barasa, and is inquiring about private credit exit options. What are we seeing within Africa or emerging markets and developing economies? I think beyond their self-liquidation mechanism, are there other exit options that we are seeing for private credit funds?
I think I would say it is easier to, a quick example, a bank can repackage its loans and put them on the market, and to the bank, they will have exited that entire loan book. So it's fairly easy to offload a debt instrument, especially as you are aware, debts, as long as there's reasonable cash flows and maybe you request for some good covenants, you're happy to hold it, or you can pass it on to another investor because there's some type of predictability. On the equity side, you're demanding a much higher return, but the downside is also unknown. And we have biases. We prefer predictability over uncertainty on any given day. I know, for example, maybe Linda, when she gets back on the call, she can advise on how they provide liquidity to investors into their funds. But their liquidity notices are 3 months. Within a 3 months notice period, you can actually liquidate from their fund. So there's been improvements around liquidations, and the experience so far is okay, and that's why you see credit kind of funds are easier. That you can opt out even before the fund even actually self-liquidates. Yeah. So they are easier to discuss. It's easier to price a debt instrument than it is to price an equity that is not listed anywhere.
Philip has a follow-on, is inquiring about continuation funds, having the ability to extend a performing portfolio of loans or credits. Is it something that maybe from a Sanlam Alliance perspective, you have seen across the group, or have you received any interest from clients within the group structures?
Not something I've experienced personally, but if you think about self-liquidating fund, it means that, so for example, you have a trade finance fund where, let's say, the maximum tenor on a loan for trade purposes is, let's say it is 6 months, all right, or 12 months. It means within that period, your funds are returned, isn't it? So which means you have to deploy them again. So you could have, let's say you have $100 million that you're utilizing for such a strategy. Remember that as it liquidates, it means you're redeploying into newer assets. So you find that there's that type of, if it is liquidating, then you have cash you can redeploy if that's a design that you feel works for you.
Linda, welcome back. We are talking about continuation funds or continuation designs in funds. And we wanted perhaps to hear from the TDB perspective. Do you build this element within your structures, enabling your funds to continue, if it's performing? Is that something that you have seen or you have designed before as TDB? Or is it something that is on the works within the institution?
Okay, I hope I've understood your question correctly, and sorry for dropping off. So with
So
the funds
just
that
as a background a little bit, we were discussing private credit exit options. And one of the questions from Philip was, what do we see as continuation vehicles as mechanism to extend performing loans or performing portfolios or performing funds? And so we're trying to appreciate from a Sanlam perspective, but also from a TDB perspective, how do you manage that element in private credit or in trade finance, where you have a vintage for a fund, it performs well, and perhaps you want to continue that fund for a period of time. How is that managed, and how have you designed that perhaps previously?
Okay, so for us, but I think the good thing about private credit and then specifically trade finance is that the need for trade finance funding is sort of evergreen. It's continuing. There will always be need for trade finance funding because trade finance is part of our everyday life. And we even have a trade financing deficit gap that's quite large. So there's a lot of assets out there that need funding. It's just a question of finding the right ones that suit within your fund and your risk profile. But it's something that happens every day. So because we recognize that, and we also had very good history in terms of how trade finance performs, from the bank side, when the funds were created, they were actually created as open-ended funds. So they don't have a specific life. They're funds that are going to be there. We want to grow it. Our flagship fund is about $450 million. And that is a drop in the ocean compared to how much is actually required in terms of trade finance funding. So there's a whole lot of business out there that we can be able to do through the funds. And therefore, we want to continue to grow the funds. We want to continue to pull funding together and funding trade finance. And with trade finance, it's short-term assets. So you're investing in a particular asset, and then when it matures, you get paid, you go move on to the next asset, or you're funding the same obligor. They've also started another batch of exports. So it goes on and on and on like that because you're funding continuing businesses, you're funding trading that is happening between countries that will always be happening at every given point in time. Even in crisis times such as COVID, there was a certain level of trade that was happening at that time also. So our funds are open-ended. They don't have an end of life date. And that ensures that we continue to raise funding and deploy them in these funds that are performing. I think the worry also is that you have a performing fund, but it has an end of life. How then do we make sure that we continue to have solid assets like that are in the market? For us, our funds are open-ended, so they're continuing, and that is how we have structured those. But then it also depends with the asset as well, right? So sometimes we'd say infrastructure funds, because you want to fund a specific something, it has to have to come to an end of life. But Africa as well is very, from the statistics that have been shared in terms of the deficit of infrastructure, it means there's a lot that needs to be funded. And if you start an infrastructure fund that performs, you structure it as an end of life date, and it performs, you have actually given like a proof of concept to say we can do this, we can fund this, and you guys can get a return, and the country can get infrastructure development. So it means you can move to the next, do a similar structuring or a suitable structuring, and then you already have buy-in because you already have a successful fund in infrastructure, and you're going on to the next fund, same asset class, maybe a different infrastructure that's being funded at that point in time, but it then works. Also, they can be open-ended as well. If you're targeting a whole lot of things, if you want to do the airport, you want to do the roads, you want to do this, you want to do that, they can have a very, very long life because there's continuous need to fund infrastructure. As long as the structuring is right, you can keep it as open for as long as possible. So we do have structures like that within TDB where we have just given these investments to the market and they're open-ended.
Thank you very much. So we have a question from Letitia. She has two questions, but I'll start with the last one. How useful are credit ratings when we are making alternative decisions, Mr. Mubali? let's start with you. Are they useful? How do you use them?
Okay. Internally, we do our own ratings. So we will. So the rating is important, but then we have capacity to do it in-house, and we
So
have
those
our own.
do you have internal models? You have.
Yes, we do. So we build for each issuer that we feel that we are trying to engage. We build something, and then we have our own, call it investment grade threshold. It can change. It can change for different reasons. For example, the you let me give an example of the commercial banks within the region. If you use the same matrices for Ugandan banks against Kenyan banks, you'll find that the the ratings for the Kenyan banks will be lower. You get my point? So you have to adjust to maybe somehow there might be some level of adjustment simply because of those differences. So the ratings are not, it's not a copy paste. You look at the different entities, you do the work around it, and then say, for this one, we feel it's below what we would ordinarily want. And also they also guide on the level of volume that you can deploy to that entity. So ratings are important because we do the work, but we don't use external ratings. We do our own ratings for all the investees that we take on.
Linda, do you do ratings for the funds, or do you use the institutional rating as it stands?
No, we do for the funds, mainly because our funds, especially the trade funds, they sit on a different balance sheet. So the rating of TDB is not a reflection on the rating of the funds because it's a different balance sheet as well. So we do ratings of the funds, and as Mubale said, ratings are very important. Of course, I think asset managers, they just don't look at an investment and they see the rating. If the rating is good, then it's a automatic investment. They do their own DD. So that's what Mbale is saying. Say ratings are very important because they're also giving them independent information. So they are additive to their DD work, but DD work is done by asset managers. So it's very important to get that because what we are doing is if we have an investment product that we are selling to asset managers or any institutional investor or individual
Mr. Mubale, so in terms of
I'm pretty much going into the fundamental
oh,
reasons or the fundamental benefits
okay.
of trade finance.
Thanks, Linda. Mr. Mubale, the second question from Letitia is around stress testing. How do you execute or implement a stress test on an alternatives exposure or portfolio? Given in mind that as you highlighted in the beginning, there are issues of currency risks, liquidity events that have to be mindful. How do you stress test those or game those out as you are doing your DD or you're doing your regular monitoring of the investments?
So in terms of stressing any security, you want to get back to basics. So any business has maybe 2 or 3 business lines at any given point in time. Beyond that, it will look a bit weird. So if you are a telecom, It means you sell data, you sell voice or GSM services, and maybe mobile money services. So you want to look at environments under which either that falls off the cliff. Could it be regulation? Would it be a competitor? Is it pricing? Is it new technology and things like that? Now, I always like using the example of COVID, that before COVID, all of us had continuity plans. But when COVID came, it dictated a significant revision to everything that we were doing, and we survived. So I always tell the team that we can think of things, but let's also be open to there are things that can actually happen that we haven't thought about. You just have to take them in stride. So besides the risk, then the next level is in terms of then trying to spread the risk out so that you're not caught out in one particular area or overly exposed to one place, so that when something really bad happens, it compromises the entire portfolio performance. So you can take a hit, but you have to have the benefit of designing an entire portfolio in the sense that even when you take a hit in one area, it is not not catastrophic to the entire portfolio. So that is the second level of management that we put in. From my experience on particularly credit, so for example, the companies that have put out, credit or medium-term notes and etc., the downside is you lose the entire investment. Okay, so you give somebody money and they disappear, and you have to do it in such a way that if that happens, it is not a crippling kind of blow. Yeah. So then, once you're happy with the onset, then from time to time, then you review and see whether you're moving in the right direction. If you feel things are not working out, then you can try and see whether you want to scale back a little bit. But if it is working, then you maintain your position.
Yeah. Right. Thank you very much. I don't know if we still have any questions from our audience. If you have any question, feel free to raise your hand, and we should be able to give you. Yes, please.
Sorry, maybe I could just come in. I think I'm having a very terrible day today. Sorry for that, but I don't know if I could just conclude on what I was saying about credit ratings, because there's another important point I wanted to raise. Yeah. So as I was saying, they're very important. They give independent information. So you don't necessarily just have to rely on what I am telling you. There's someone who's independent who has actually looked at the fund and determined that it deserves this sort of rating, be it investment grade or sub-investment grade. That's important information. Of course, that is not the only thing that professionals rely on to make a decision on investments. They also do their own DDs. But I guess the other most important thing is that we've had particular investors, for example, insurance companies, that are required to invest in funds that are rated, or can invest in unrated funds, but then it comes at a huge capital charge to them. So the moment there's a rating, then the capital charge becomes much, much less, and sometimes it's not even there. So ratings are important because it then expands the universe of investors that you can target. If your fund is not rated, then because of that capital charge, you'd find insurance companies tend to not be like your target pool of raising funding because of that. But however, they actually have a lot of money, and it is money that can also go into developing, whether it's infrastructure, trade finance, whatever it is you're fundraising for. So on overall, it's important. It's just that, as a professional, you also look at other things, but the rating is very additive.
Okay, cool. I think we have one additional question. Anthony Morini would like to ask a question. Please go ahead. I don't know if you have permission to speak, but if you do, please go ahead. Anthony?
I don't know whether you can hear me.
Yes, we can. Please go ahead.
Good evening. How are you?
Great.
My question is directed to Linda of TDB, and it circles around asset-backed securities, especially asset-backed securities backed by commodities, and how these securities or these asset-backed securities can be used to improve the credit rating of a country while being attached to a sovereign wealth fund. Maybe you could speak more to it, especially from the point of view of junior, mezzanine, and senior mezzanine, or the senior tranches. Because I'm interested to understand how it works and how the two are intertwined and how they can help a sovereign improve their credit rating and probably even their financial status. I hope I'm clear enough, Linda.
Yes, I think I understood the question. And I would say I think you probably touched on two things that are related but not exactly the same. So when you look at a sovereign credit rating, the rating of a country, it's more than just what the assets are in that particular country. So they look at a whole lot of other things. They look at they even when you look at how rating agencies rate countries, they even have a forward-looking perspective in terms of what are the things that make up your GDP. Which sectors are these? Are the sectors in trouble or they're not? Are they going to boom in the couple of coming years or not? What then does this mean for the income of the country? And what then does this mean for the ability of the country to actually be able to pay its debt? So remember, credit ratings are all about how suitable are you, or at what level do we put you in terms of capacity and willingness to pay your debt. So a sovereign rating is looking at it from a macro perspective, looking at the country accounts and saying, in terms of your income, given where you get your income from, are you still going to be able to service your debt? Are you not going to fall into default? And then that then attaches that rating to your country's sovereign paper to say, no, they have borrowed, but they can pay because mining is going to boom. Look at what happened in Botswana, for example. It's not like there was a change in attitude of repayment, but there was a structural change in the diamond industry, and there was a lot of worry from credit rating agencies to say this economy is heavily dependent on diamonds. So what does this mean for the obligations that they have, for example? And of course, there are a lot of buffers in Botswana which helped them, but it was a point of concern. So that is how sovereign credit ratings are done. So when you then come to individual assets now, that's a different rating in itself. But the unfortunate thing is where it's related is that when a rating is being done on say particular assets in country, especially in that particular currency, they tend to start working from a macro level. What is the country's rating? That becomes the first basis or the anchor basis. And then they come down to the asset. And when an asset has got, say it's an asset-backed fund, where there is like, I don't know, some form of asset collateral behind, it's different from when you're looking at just something that's unsecuritized in terms of risk profiling. So that also then has impact in terms of ratings. But on overall, in inward or in country rating or in country fund rating, will then also take on from the sovereign rating. So that is where they are then linked. But the sovereign rating is more what then cascades down, as opposed to the rating of different funds cascading upwards. So the anchoring comes from the sovereign, and then the sovereign anchors the internal funds. Then each particular fund now in terms of rating is dependent on structure, is dependent on security, is it asset backed, how easy is it to actually act on these assets in the event of default, for example. So it's not just having collateral, but the quality of your collateral or the easy execution of your collateral. All those factors are put together before a rating is then done. So, for example, our funds are domiciled in Mauritius, which is investment grade. And then, furthermore, when coming down to the fund, they are looking at the liquidity profile of the fund. They're looking at the structure of the assets. How do we get paid? What do we take collateral? And we mainly look at cash flows and access to cash flows, which is an easier execution of collateral, maybe as opposed to something a bit more hard. And considering we are dealing jurisdictional, access to cash flow works much, much better for us than something that's a bit more fixed, a bit more hardened. So all these factors are put together and then a rating is then done. But the relationship between the sovereign one and the funds one, it's more the sovereign fund then cascading down to the local funds, and then that tends to then have an impact in terms of the rating of that particular fund. I hope I've answered you. Please let me know if I haven't.
You've done justice to the question, and I'll really request if you can chat me your contacts so that I
Okay.
can take it up with you even offline. Thank you.
Sure. Thank you, Anthony.
How will I get your contacts?
I'm going to put my email address in the chat for everyone, I guess, in the event that they want to reach me via email.
Okay, thank you.
Thank you, Linda. Do we have any other questions from our esteemed audience? Good. I think we have had a very interesting discussion today, why East African institutional investors are paying more attention to alternative investments now. And I want to share what my key pickups from today, key takeaways were. I saw or I heard that dollar returns are attractive to institutional investors, both in East Africa and beyond. And this is the attraction that makes or situates alternatives much better than traditional investments within East Africa that are based on local returns. So despite local returns being high yield, the dollar element in the alternative assets that have been structured by the two institutions that we are talking about have attracted investors to these funds in particular. There's also an issue in concentration where institutional investors are looking to diversify their portfolios. So they are looking for other investments away from the traditionals, which sometimes are exposed to strategic and political risks. And so to minimize these sovereign risks, diversification into other funds starts to make sense. And we are seeing that gradual shift as well. We discussed, and I heard from the two speakers about the opportunities that are emerging through the enlargement of the East Africa community, where there is increased interest to develop infrastructure, develop these economies. So this creates an opportunity for alternative assets. And the speakers highlighted that there is a lot of focus on real assets, infrastructure. We are seeing interest in private credit, and they highlighted a focus on trade finance as one of those interesting areas that are self-liquidating in nature. They also highlighted, our speakers highlighted that ESG standards are likely to be important in the coming years, with a mandatory element coming in 2030, where then all institutions would be required, anybody reporting under the International Financial Reporting Standards will be required to also report on the ESG elements. We also spoke about the global fragmentation, whether it's an opportunity or a risk for Africa investments. And we see that at the moment it's premature to celebrate, but perhaps as we go on in the coming years, it may present an opportunity for us. And we have seen that with Dangote's refinery in Nigeria being upgraded from a risky investment to now a viable investment. We're also seeing that in the Uganda case, the Ugandan refinery that had gone to the bins, but now is back online as a viable project, given what we are seeing in the global, in the geopolitics space. The speakers also highlighted that due diligence is critical. Ratings, reviews, paying particular attention on the assets you are investing in, that is important to make this work. Alternative investment is slightly different from traditional assets, where you're required to roll up your sleeves and do a little more digging to assess and evaluate the suitability and reasonableness of the investment you are making. Those were my key takeaways from this. I hope I've summarized them well. And in case we want to keep this conversation going, we do have the Alternative Investment Conference coming up in July. And this is one of those webinars leading us into that conversation in Kampala on July 15th. So we expect to speak more about these matters of alternative investments. We believe it's a movement, it's a reallocation that is happening, and all of us as professionals, as investors, as interested parties, we need to be more aware about the shift that is happening. But before we close, let me invite our panelists to just use 2 minutes, 2 to 3 minutes, just to share your closing thoughts. If you are speaking to a board of allocators, a board of trustees, a board of directors of an institution of investor, what are the key things you want to paint out? What are the themes you would like to highlight? What do you see as going to be leading themes in the next 3 to 5 years? And how do you want them to harness or bring these themes into their portfolio decision making? We could use these 2 to 3 minutes to hear your thoughts about that before we close. Bubale, you want to go first?
Okay, so I would want to see the trustees look at longer term horizons in general, and also have some type of appreciation that we can design investment strategies for 5 years. Right now, as it stands, we are evaluated almost on a quarterly basis, so they want to see something now. And there's the pressure of every year members want to have a particular return on investment, double digit. So that somehow also constrains a couple of managers on how they can deploy assets. So in terms of design, duration is something that I would wish our clients to relook. Then internally, definitely many of us have started to utilize the technology, the artificial intelligence tools. I'd say that they are taking on a bit of prominence in terms of our work, not just within Uganda, but also abroad. I believe that there are tools that can ensure that people don't spend hours and hours in the office, so they can improve on our efficiency to do work in terms of what we need to do in terms of designing and executing on portfolios. So there could be other things in between in terms of, let's say, a risk COVID or a boom or something like that. But some of the two themes that I feel should transcend that is our capacity to, or our appetite for duration, for longer duration assets, not just government bonds, but alternative assets, and also our efficiencies as firms in terms of the work that we do in order to make our deliverables to the customers much better.
Right, thank you, Mubale. Linda, any closing thoughts?
Yes, I guess for me, the message I would drive is it's very important to diversify. There is a lot of gravitation towards government securities. There has been for a long time. Nothing wrong with that, but also it is important to add other asset classes into your portfolios to just hedge against the risks of being concentrated in one asset class. And as we have been discussing, alternative investments offer a very good platform for you to be able to do that. Of course, there's a lot of talk around that. But the advice is also that the investment into alternative investments should be very robust. And it should meet the requirements of the investor. So from a return and risk perspective, it has to make sense. And then from an accretive perspective, it's accretive, yes. We've spoken about the benefits, but look at all the sectors in which you want it to be accretive to your own portfolio. Long term is also very important, but I guess the worry is exits, the worry is liquidity, and the emergence of private credit as an alternative investment has actually come in to solve the liquidity worries and concerns that investors have. Therefore, it is an alternative investment that investors can start looking at to add into their portfolios. And of course, other alternative investments that are coming, like infrastructure funds. You look at how they're structured, how they fit with their needs, and then that is how investors can look at alternative investments. We believe on overall, there's a lot of benefits in actually bringing these asset classes to your portfolios. Thank you, Alan.
Thank you, Len. Thank you, Linda, for this. Mubali and Linda, thank you very much for speaking to us for the last 1 hour and 40 minutes. It was really insightful. And I'm sure for all those who have stayed with us for the 1 hour and 40 minutes, it's been really a very great conversation to hear from you and your perspectives. We look forward to having you join us at the Alternative Investment Conference in July, where we can continue these conversations as well. And I would invite my colleagues, Ruth, to give us some closings and give us some takeaways as we close the session today. On my side, I want to thank all of you for a great audience and the panelists for some great insights we have received today. Wish you all a lovely evening and enjoy your weekend as it comes up. Ruth, I hand it back to you. Kindly take us through the closings and then we can depart at least. Thank you very much.
Thank you so much. Thank you so much, Alan. Thank you so much to Mubali and Linda. I think this session was very insightful. And Alan, I think you'd already touched on the parting shots, but I just want to highlight that this conversation is a conversation that, yes, as Alan has mentioned, can be carried forward and is a lead-up conversation to the main conference, which is on 15th July. We encourage all the attendees here today to look out for more content that we'll be sharing, that will be leading up to the conversation, and much more topics related to this that will be much elaborated during the conference. So with that said, the recording of this session will be available to both those that have been able to attend and those that failed to attend today but had already registered, because we had over 100 people interested in this session. Unfortunately, for one reason or the other, they've not been able to attend. So we'll surely share that recording with them. And the conversation will continue. Mubali and Linda, Alan will surely reach out to you in case we have any follow-on conversations from the recording so that we can make this more enriching. Thank you so much for your time, and we appreciate.
Right. Everybody, good night and have a lovely evening for those
Thank you.
still active.
Thank you, everyone.
Bye-bye.